let's review some basic inventory concepts. Inventory is a current asset. Because inventory will be used or converted into cash within 1 year, it is classified as a current asset on the balance sheet. The amount of the inventory that was sold during the current year is an expense and is shown on the income statement as the cost of goods sold. Sales minus cost of goods sold gives us gross profit. We sold $28,000 of inventory and we have $12,000 left. The cost of goods sold formula, as shown here, displays the very important relationships in the inventory area. As you can see, we start with $22,000 of inventory and then buy $18,000 more. The total amount we now have available to sell is $40,000 of inventory, $22,000 plus $18,000. Therefore, if I have $12,000 left at the end, I must have sold $28,000. The cost of goods sold is $28,000. Review this data showing a retail store's shirt inventory. We started the month with 10 shirts. During the month, we bought 12 more at various costs to us. Then we sold 11 of the total of 22 shirts. Therefore, we have 11 left. On the next 5 slides, we will show computing inventory valuation using the first in, first out FIFO, last in, first out LIFO, and average cost methods with a periodic inventory system. We sold 11 of the shirts. The question is, how do we compute the cost of the shirts sold and the ending inventory? Don't forget that the shirts were either sold or they are in the ending inventory. The total of the cost of goods sold and the ending inventory must equal $252, regardless of how we allocate it. There are 3 common ways to value the ending inventory and cost of goods sold. On the next series of slides, I will go through all 3, one at a time. The first method is called first in, first out, or more commonly called FIFO. What this means is that the first ones you owned are considered the first ones sold. Based on what we had in our beginning inventory and what we purchased, we have 22 shirts with a total cost of $252 available for sale. In this example, you sold 11 shirts. 10 of those 11 are from the first 10 you had at $10 each. The 11th one is from the June 1st purchase where you bought 5 shirts at $12 each. 10 at $10 equals $100. One more at $12 equals $12. Therefore, the total cost of goods sold is $112. 100 plus the $12. Thus, the ending inventory of 11 shirts must consist of the other 4 bought at $12 on June 2nd, the 3 bought on June 10th at $12, and the 4 bought on June 13th for $14 each. This totals $140. The second method is called last in, first out, or more commonly called LIFO. What this means is that the last ones you owned are considered the first ones sold. Once again, based on what we had in our beginning inventory and what we purchased, we have 22 shirts with a total cost of $252 available for sale. Available for sale is the same regardless of what inventory costing method we use. You sold 11 shirts. 4 of those 11 are from the last 4 you bought for $14 each. 3 of them are from the June 10th purchase at $12 each. The remaining 4 are from the June 2nd purchase at $12 each. 4 at $14 equals $56. 3 at $12 equals $36. And 4 at $12 equals $48. 56 plus 36 plus 48 equals $140. Therefore, the total cost for the cost of goods sold is $140. The ending inventory must consist of the remaining shirt bought on June 2nd for $12 and the 10 at $10 each in the beginning inventory. $12 plus $100 equals the $112 ending inventory. When we use the weighted average method, we must compute the average cost. Once again, based on what we had in our beginning inventory and what we purchased, we have 22 shirts with a total cost of $252 available for sale. Available for sale is the same regardless of what inventory costing method we use. Total cost was $252 and we had 22 shirts, so the average cost is $252 divided by 22, or $11.455. In this example, since we sold 11 shirts, the cost of goods sold is 11 times $11.45, or $126. As we have 11 left, the ending inventory would be 11 times 11.455, or $126. Let's compare the results of the 3 methods. Sales is the same regardless of which method you use. 11 shirts times $20 equals $220. Purchases are the same at $152. The cost of goods available for sale is the same at $252. Now we get to the difference. The difference is caused by how we allocate the goods available for sale into cost of goods sold or ending inventory. Note how this affects our profit. Under the FIFO system, inventory is valued at approximate replacement cost. Under LIFO, inventory is valued at oldest cost. In a period of rising prices, FIFO results in higher pre-tax income, and LIFO results in lower pre-tax income.